Investors are often said to be constantly fighting the last war, meaning they are emotionally inclined to pay more attention to recent events when making forecasts, and they extrapolate current trends indefinitely into the future. This does have one advantage in the sense that while we remember the pain of a crisis, we will jump into action to prevent anything similar from happening again. And that has been evidenced in previous global crises. So in this instance, we can be assured that the world will make dramatic changes in order to be more proactive against the next major pandemic, which in return reduces the likelihood thereof. It's important to note that while it is hard to estimate how lockdowns will impact company profits over the next year, these profits only contribute around 3 to 5% of a company's long-term valuation. So in theory, in terms of long-term valuation, it doesn't matter too much if profits decline by 20% or even 60% in a single year, assuming a company's balance sheet is strong enough to survive. It is the pace and the extent of earnings recovery that is far more important for long-term valuation. We can't predict with certainty what will happen after the current crisis, nor can we forecast what the next one will look like. In the face of uncertainty, our approach at Sanlam Private Wealth in managing investment portfolios through uncertainty is to, firstly, ensure that portfolios are diversified appropriately to protect against unforeseen events. Secondly, we ensure that our portfolio companies have adequate financial strength and cash generation throughout the cycle to be able to withstand downturns. And finally, and probably the most important, our investment process will continue to focus on the price we pay for assets, which is the one thing that we are certain about. And that price or the valuation must offer both better prospective returns and margin of safety for when things don't go according to plan.